ETFs or exchange traded funds have recently gained significant acceptance among Indian investors. This is essentially due to the unique features that ETFs offer vis-à-vis mutual funds. These financial instruments are particularly beneficial for investors who may lack the technical skills of analyzing and selecting individual stocks for investment. As these instruments grow in popularity, various AMCs have started offering ETFs that replicate indices like NSE, with an objective to provide returns in line with the total returns of the securities that constitute the index. In this video, we will try to provide as much information as possible about ETFs, and we will be covering the following topics. Hi, I am Pratap Narula, investment consultant and educator, and if you like my video, please put in your likes and subscribe to my channel. Also, ring that bell to get all future notifications from this channel and put in your feedbacks and comments. Further, put in your questions in the comment box and I shall get back to you on the same. So let's come to the very first question that comes to our mind, which is what exactly are ETFs or exchange traded funds? ETFs or exchange traded funds are a type of marketable security that combine the best features of two popular assets. They combine the diversification benefits of mutual funds along with the simplicity with which equities may be exchanged or traded. ETFs give you an affordable way to access a wide variety of asset categories. Thus, ETFs are a basket of different securities like stocks, bonds, commodities, and others that combine the flexibility of stocks with the diversification of mutual funds. Exchange traded funds are innovative investment options that combine the features of stocks and mutual funds. Like stocks, they are listed on NSE or BSE and can be traded through demat accounts during open market hours. Similarly, like mutual funds, these schemes offer you access to a diversified portfolio that spans across the strategic sectors of the economy. The purpose of an ETF is to match a particular market index, leading to a fund management style known as passive management. Essentially, the investor in an ETF wants the returns to replicate those from the benchmark index as accurately as possible. Mostly, ETFs are passively managed funds that seek to achieve the same return as a particular market index, while others are actively managed funds that buy or sell investments consistent with the stated investment objective. Next, let's come to how an ETF functions. The working of an ETF can be summarized in the following manner. An ETF provider takes into account the universe of assets such as stocks, bonds, commodities, or currencies, and builds a basket of them, each with its own ticker or monitoring system. The fund provider owns the underlying assets, designs a fund to track their performance, and then sells shares in that fund to investors. Investors can buy a share in that ETF in the same way that they would buy stock in a firm that trades on an exchange. Shareholders own a portion of an ETF, but they don't own the underlying assets in that fund. Even so, investors in an ETF that tracks a stock index may get lump sum dividend payments or reinvestments for the stocks that make up the index. Like a stock, buyers and sellers trade the ETF on an exchange throughout the day. The price of an ETF would therefore keep on changing during trading hours on the basis of the change in the price of the underlying securities. Let us now look at some key differences between ETFs and mutual funds. ETFs are traded on an exchange throughout the day, while mutual funds are transacted through mutual fund companies or brokerage firms. ETFs are traded on an intraday basis when the market is open, while mutual funds are executed on a daily basis at market close time. ETFs have a very low minimum investment, typically one share, while mutual funds may have high minimums like 5,000 rupees for lump sum investments. ETF holdings are generally published on a daily basis, while in the case of mutual funds, it is quarterly or once in 3 months. Expense ratios of ETFs are generally lower due to passive management and generally higher in mutual funds due to active management. There are no sale charges in the case of ETFs, though ordinary brokerage commissions apply, but mutual funds may have sales load and purchase or redemption fees. A demat account is required in the case of ETFs, but not for mutual funds. ETFs mostly have a passive management style and mutual funds are mostly actively managed. ETFs attempt to replicate the index benchmark, while mutual funds aim to beat the benchmark. ETF assets are typically fully invested, while mutual funds usually hold at least 5% in order to handle redemptions. ETFs began their journey in India way back in 2002 when the first ETF by Nippon India Mutual Fund, originally introduced by Benchmark Asset Management Company, was launched in India on the NSE. The ETF was listed on January 8, 2002 and day 1 witnessed trading of Rs 1.3 crores. The journey to listing of the 100th ETF on NSE took more than 19 years. The year 2021 witnessed a lot of activity in the ETF space, with 21 ETFs getting listed. The assets under management of ETFs in India stood at Rs 3.16 lakh crores at the end of May 21, witnessing more than 13.8 times increase in 5 years, as compared to Rs 23,000 crores at the end of April 2016. The Indian ETF market is booming, with its assets under management growing fivefold since 2018. The AUM of Indian ETFs as of March 2018 was Rs 78,664 crores, which increased to Rs 5,20,232 crores by the end of 2022. Let's now review the pros and cons of ETFs. ETFs are an increasingly popular investment for many reasons. Here are some of them. ETFs give you an efficient way to diversify your portfolio without having to select individual stocks or bonds. They cover most major asset classes and sectors, offering you a broad selection. International, regional, and ETFs for specific industries and market niches provide access to sectors where it may be more difficult to buy and sell individual stocks and bonds. ETFs, which are passively managed, have considerably lower cost than mutual funds, which are often actively managed. Management fees, shareholder accounting expenditures at the fund level, service fees such as marketing, paying a board of directors, and load fees for selling and distribution can be the reasons for higher cost ratios of mutual funds. ETFs are bought and sold on a stock exchange and may be traded at any time during the day, not only at the end of the day. When volatility is high, this can be a significant benefit. ETFs are very versatile, letting you easily move money between specific asset classes like stocks, bonds, or commodities. Most ETFs disclose their holdings daily, allowing investors to track the performance of their investments and make informed decisions. ETFs typically hold the same securities as the specific index or benchmark they track, although some may hold a representative sample of the index securities. Since most ETFs are not actively managed but are programmed to follow a specific index, they generally do not have high capital gains and other incomes that are required to be passed on to the owners each year. ETFs tend to have very low minimum investments, meaning you don't need to have a lot of money to get started. You can start building a portfolio of ETFs with just a few hundred rupees and top up as you go. But ETFs have some disadvantages also. Due to a small number of securities in the market index, investors may be limited to large cap companies in particular sectors or international stocks. Due to a lack of exposure to mid and small cap firms, ETF investors may miss out on significant growth possibilities. However, this should not be a drawback for long. Longer term investors may not gain from intraday pricing fluctuations since their time horizon is 10 to 15 years. Because of the delayed fluctuations in hourly prices, some investors may trade more. A large movement in price over a few hours might trigger a transaction, with pricing at the end of the day preventing irrational concerns from distorting an investment goal. Dividend paying ETFs exist, but their yields may not be as high as holding a high yielding stock or group of companies. The dangers of holding ETFs are typically smaller, but if an investor is willing to accept the risk, stock dividend payouts may be considerably greater. While you can choose the stock with the greatest dividend yield, ETFs track a larger market, resulting in a lower total yield. ETFs are subject to real-world frictions that don't affect indices. As a result, ETFs may not always track their underlying index perfectly, which can result in a tracking error where the ETF's performance deviates from the index. We shall look at tracking error further in the video. After understanding the pros and cons of ETFs, let's move further with how to invest in ETFs. ETF transactions are carried out on the stock exchange where they are listed just like all other stocks. You need to open a trading account with a broker or sub-broker or any other platform to be able to carry out these transactions. You should also have a demat account for holding the ETF units. Now, to complete these formalities, you have to be KYC compliant and will be required to furnish documents like proof of identity, proof of address, bank account details, and a few others. Units on the exchange are traded on the basis of real-time market price prevailing at the time of placing the order. ETF investors must bear brokerage payable on transactions and any adverse price due to the limited liquidity of ETFs. You can invest in ETFs by buying or selling ETF units through the broker by telephonic mode or by placing orders on the online trading interface provided by the broker. But before starting to invest in ETFs, you also need to know how to find the right ETFs for your portfolio. There are now over 150 ETFs available for investors in India, and it is not easy to keep track of them all. It can feel overwhelming to select just those that fit your strategy and goals. There are several selection criteria that help you to narrow down the most cost-effective ETF for each asset class or index you want to own. Further mentioned are some key points to remember. Before you start selecting a specific ETF, you first determine your investment focus. You decide on an asset class such as equities or bonds and determine its weighting in your portfolio. Next up is your diversification strategy. Do you want to spread your wealth widely across an asset class or capture unique market segments? For example, in equities, you can tilt towards emerging markets, or you can focus on specific industries or specific investment themes. After that, it's time to think about the index your ETF will track. A good index covers as much of the market as possible. Once you have selected one or more indices, you can compare the available ETFs. For example, the NSE index tracks a major part of the investable Indian stock market. ETFs on well-known stock indices are offered by almost every major ETF provider. The more equities a market index tracks, the better it represents your market. Broad market indices are best for diversification, regardless of whether you want to invest in just one ETF or build a portfolio of several ETFs. The more an index concentrates on particular firms, industries, and countries, the riskier it will be in comparison to a broader index. Lastly, it's time to dive deeper into the filters that will help you to pick out a top-notch ETF. Many different factors play a role in ETF selection, which are further listed out. The fund volume determines the profitability of an ETF. Favor a fund size with a higher AUM or assets under management. To be considered a viable investment choice, an ETF should have a minimum threshold level. An ETF with assets below this threshold is likely to have a limited degree of investor interest, which translates into poor liquidity and wide spreads. You can better compare ETFs once they've built up a reasonable track record. You need a bare minimum of at least 1 year's performance data. 3 years is much better, and 5 years is better still for a long-term investment. ETFs that have only recently been launched usually have a rather low fund volume. In such cases, it is often unclear whether the ETF has a low volume only because of its short duration or whether it is simply not in demand. An investor needs to check if the ETF that is being considered trades in sufficient volumes on a daily basis. Trading volume in the most popular ETFs runs into crores daily, while some ETFs barely trade at all. Basically, the higher the trading volume for an ETF, the more liquid it is likely to be, and with a minimal bid-ask spread. The perfect ETF would deliver exactly the same return as its index. But ETFs are subject to real-world frictions and must pay transaction charges, taxes, regulatory fees, and a list of other costs. Indices, meanwhile, are virtual league tables, so are free to compute the return of a market untroubled by ETF drag factors. The gap between an ETF's real-world return and an index's virtual return is called tracking error. A good ETF minimizes the tracking error, which theoretically equals the market return of the index minus the running costs of the ETF. One of the great advantages of ETFs is their low cost compared to other investments such as actively managed mutual funds. To assess the cost of an ETF, you can look at the total expense ratio or TER, which measures the approximate annual charge you can expect to pay for holding an ETF. It totals up the various administrative, legal, operational, and marketing costs incurred by the ETFs. This information is comparable and should definitely be taken into account while selecting an ETF. Typically, you'll pay a commission when you buy or sell an ETF, just like any other exchange-traded security. Over time, those commissions can really add up and become cost prohibitive. Not all brokers charge you a commission when you trade an ETF online. Always check before you trade. Order fees are incurred when buying an ETF. These usually vary depending on the broker. In addition to this, the bid-offer spread is another expense which must be taken into account. This is the difference between the highest price that a buyer is willing to pay for an ETF and the lowest price that a seller is willing to accept. The larger the spread and the more frequently you trade, the more relevant this cost becomes. The more liquid an ETF is, the more likely it is that you can buy and sell it swiftly for a minimal spread. For example, an ETF that holds the same securities that are traded on the NSE can also be exchanged rapidly due to high liquidity with a minimal markup on the price. An ETF's liquidity is based on the number of firms interested in buying or selling that ETF at a given point in time. Higher liquidity can shrink bid-offer spreads, since the more interested firms there are, the closer the highest and lowest offered prices to sell are likely to be, and vice versa. Distributing ETFs pay interest or dividends directly into your account, so you can spend it or reinvest it as you seem fit. Accumulating or capitalizing ETFs don't pay out income but automatically reinvest it back into the product. That increases the value of your ETF share, saves on transaction cost, and will grow the value of your investment over time using the compound effect. ETFs are run by major banks and fund companies. The mark of a good ETF provider is how it treats its customers, so look out for points like clear presentation, easy accessibility, transparency, and design simplicity, apart from past performance of other ETFs. By applying these filters, you will be able to easily dial up a selection of ETFs suitable for your needs. Then you can zoom in on the finer details and can find out exactly how the ETF search works. Investors should understand that there are different types of ETFs available for investing in India. The goals, funds invested, and the potential returns of these ETFs will vary based on their type. Most ETFs in India are categorized based on the underlying assets held in the portfolio. Some are Nifty and Sensex based, while others are their variants. We have a wide variety of ETFs which are available for investment based on their underlying assets. Apart from this, ETF selection can also be done on the basis of a few other categorizations like asset class, where you have stock, bonds, commodity, currency ETFs and others. On the basis of diversification, where you have sectoral and thematic, market capitalization, international ETFs and others. On the basis of investment strategy, where you have active and passive management. And on the basis of investor goals, like dividend, growth, value ETFs and others. Finally, let us look at the taxation rules for ETFs in India. Taxation is one of the crucial factors on the income earned from ETFs. Investors can earn income in three different forms from ETFs, namely capital gains, dividend income, and interest income. The first income being capital gains. Capital gains are levied at the time of sale or redemption of units of the ETFs. The profit earned through such transactions are subject to the levy of capital gains tax. Such capital gains are dependent on the type of ETF as well as the period of holding. ETFs are divided into two categories for the purposes of capital gains taxation, which are equity ETFs and other ETFs. Equity ETFs invest in equity-oriented instruments, and a few examples are large caps, mid caps, sectoral, and others. ETFs such as gold, international, debt, bond, and others fall under the other ETFs category. Tax on capital gains in ETFs is similar to the tax treatment of mutual funds. The tax structure for capital gains is tabled in the upcoming slides. Capital gains on equity ETFs held for a period less than 12 months are categorized as short-term capital gains, and for a period greater than that are categorized as long-term capital gains. Short-term capital gains on equity ETFs are taxed at a flat rate of 15% irrespective of your income tax bracket. Similarly, long-term capital gains of up to Rs 1 lakh in a financial year are tax exempt. Any long-term capital gains exceeding this limit of 1 lakh attract tax at the rate of 10%. Capital gains on other ETFs held for a period less than 36 months are categorized as short-term capital gains, and for a period greater than that are categorized as long-term capital gains. In the case of other ETFs, short-term capital gains are added to your taxable income and taxed at your income tax slab rate. Accordingly, long-term capital gains are taxed at a flat rate of 20% after applying indexation benefit. For more information on indexation, you can view my video through the link on top of your screen or in the description section of this video. Coming to dividend income, the dividends earned from ETFs were earlier taxed in the hands of the company issuing such dividends. They were subject to dividend distribution tax at the rate of 15%. However, from the financial year 2021, the dividend earned from ETFs is taxed in the hands of the investors. This income is subject to tax at the applicable income tax slab rate for the investor. Lastly, we come to interest income. Fixed income ETFs pay interest income which is taxable under the head income from other sources at the applicable tax slab rates. Because of the versatility, liquidity, and low trading costs that ETFs offer, they are an increasingly popular investment vehicle. Investors are urged to explore the large varied offerings of ETFs and to consider making ETF investments a mainstay of their overall investment portfolio. ETFs represent a cost-effective way to gain exposure to a broad basket of securities with a limited budget. Instead of buying individual stocks, the investor can simply buy shares of a fund that targets a representative cost section of the wider market. I hope you enjoyed watching my video, and please do like and subscribe to my channel and click the bell icon to get new video updates. Thank you.